Welcome to Booming Bull Bear, where smart traders are made. Before we dive in, don't forget to hit that subscribe button. Like this video if you find it valuable. Drop your thoughts in the comments and share it with fellow traders who want to win in the markets. In this video, we're diving deep into the 5 trading mindset, secrets the pros don't want you to know. You'll learn how to keep a powerful trading journal, set unbreakable rules, master the pause button to control emotions, protect your capital with smart risk management eyes, and play the long game for consistent success. Whether you're a beginner or a seasoned trader, these secrets will change the way you think and trade forever. Let's get started. In trading, knowledge is power, but self-knowledge is a superpower. A trading journal is more than just a notebook. It's your personal laboratory, your truth teller, and your silent mentor. Every great trader has one thing in common. They track, review, and learn from their trades. Why keep a trading journal? When you're in the middle of a trade, emotions can cloud reality. You might think you remember why you entered, but a week later details fade, and bias creeps in. By writing down every trade, your reasons, your emotional state, and the final outcome, you create an honest record that can't be rewritten by memory. It's like replaying your own game footage. Athletes watch replays to improve performance. Traders have their journals. Over time, patterns emerge. Maybe you always trade too large after a win, or you enter too early when you're afraid of missing out. What to record? Your journal should capture hard hit and time, when you took the trade, asset and direction, what you traded, e.g. your USD long or short, entry and exit price, exact numbers for precision, position size, how much you risked, reason for entry, your technical or fundamental setup, emotional state, calm, nervous, overconfident, result, profit or loss and by how much, post-trade reflection, what went well, what could be improved, emotional tracking, the hidden key. Numbers tell part of the story, but emotions tell the rest. Write honestly about how you felt before, during, and after each trade. Fear can cause early exits. Greed can push you to hold too long. Frustration after a loss can lead to revenge trading. Recognizing these patterns is step 1 in controlling them. How to use your journal for growth. A journal is useless if it's never reviewed. Once a week, go back and study your trades like a coach reviewing match tapes. Ask yourself, do I follow my own rules? Which setups are most profitable for me? Which mistakes keep repeating? You'll start to see that profitable trading is not about predicting the market perfectly. It's about knowing yourself and avoiding self-sabotage. A simple template. Date, asset, entry, exit, size, setup, emotion, result, notes. Fill it after every trade without skipping. The discipline of recording forces you to be honest, and honesty builds mastery. A trading journal is your mirror. Some days you'll love what you see, other days it will sting, but every page is a step toward the trader you're meant to become. In the heat of the market, your biggest enemy isn't volatility, it's impulsive decision-making. Charts can move fast, prices can spike, and your brain can get hijacked by adrenaline. That's why the most successful traders make their decisions before the market even opens. Preset trading rules act like a pilot's flight plan. Once you're airborne, you don't make random turns. You follow a route. The same goes for trading. Your entry, exit, stop loss, and take profit levels must be defined in advance, so emotions don't take over mid-flight. Why rules matter? Without rules, trading becomes gambling. You may win by luck today, but luck always runs out. Rules give you a structured framework. That keeps you consistent over hundreds of trades. Imagine you're long on a stock at $100. Without rules, you might keep holding because it might go higher, so only to watch it crash to 90. With preset take profit and stop loss points, your decision is already made, protecting both profits and capital. The core elements of a trading plan. 1. Entry criteria. Define exactly what must happen for you to enter a trade. Chart patterns, indicators, news events. No guesswork. 2. Stop loss placement. Decide in advance how much you're willing to lose. It's your seatbelt in a crash. 3. Take profit level. Set a realistic profit target based on your risk-reward ratio, e.g., 1, 2, or 1, 3. 4. Position size. Determine how many units or shares to trade, based on your risk percentage. 5. Exit conditions. Besides your take profit, plan for emergency exits, e.g. sudden market reversal. Risk-reward ratios. Your profit safety net. The risk-reward ratio ensures your winners outweigh your losers. For example, risking $100 to make $300 1-3 means you can be wrong more times than you're right and still make money. Traders who skip this step often experience the one big loss that wipes out months of gains. Protecting yourself from emotional override. When you're in a live trade and prices move against you, the temptation to just wait a bit longer is huge. That's your emotional brain talking. Preset rules silence that voice. Think of your rules as a contract between you now, calm, logical, and you later, emotional, fearful, or greedy. Stick to the contract. Action step, your rule checklist. Before trading, write down my setup, my entry, my stop loss, my take profit, my position size, deal. When you treat your rules like unbreakable laws, you stop trading on adrenaline and start trading with purpose. And in trading, purpose always beats impulse. In trading, the fastest way to lose money isn't a bad setup. It's a bad state of mind. Fear, greed, and frustration can hijack your thinking, push you into reckless trades, and drain your account faster than any market crash. The antidote: learning when to pause. The best traders know that sometimes the smartest move is no move at all. Just like a chess grandmaster, they wait, breathe, and let the emotional storm pass before making their next play. Why pausing works? When emotions run high, the brain shifts into fight or flight mode. Logical thinking shuts down and impulse takes the wheel. By pausing, and even for a minute, you give your brain time to switch back to rational mode. That small break can be the difference between a controlled trade and a costly mistake. When to hit the pause button. 1. After a big win, overconfidence kicks in, making you feel invincible. This is when traders start taking unnecessary risks. 2. After a big loss, anger and frustration can push you into revenge trading, trying to win it back immediately. 3. During rapid market moves, sudden spikes can trigger fear of missing out, FOMO, leading to rushed entries. For when your emotions spike, if your heart rate jumps or your palms sweat, step away before clicking buy or sell. Practical pause techniques. Step away from the screen. Go make a coffee, take a walk, or even wash your face. Changing your environment resets your mind. Deep breathing exercises. Inhale for 4 seconds. Hold for 4, exhale for 4, hold for 4, repeat until calm. Set a timer. Force yourself to wait. 5 or 10 minutes before taking a trade you feel emotional about. Talk it out. Share your thought process with a trading buddy or community. Explaining forces you to slow down. The story of a saved account. One trader I know was down heavily after a losing streak. In frustration, he was about to triple his position size on the next trade. Instead, he took a walk. By the time he returned, the setup had completely invalidated. That pause saved him thousands and reminded him that patience is a position too. Action step: build your own pause plan. Write down 3 things you will do when emotions spike. Keep that list next to your desk. The moment you feel heat rising, follow it without question. Pausing isn't weakness, it's strength in disguise. In trading, the pause button is often the most profitable button you can press. Every trader hears it. Few truly follow it. Only risk money you can afford to lose. It sounds simple, but the psychology behind it is powerful. Trading with money you need, rent, bills, emergency funds, is like playing poker with your life savings. The moment the stakes become too personal, fear takes control, and rational decision-making disappears. Why scared money loses? When the money you're risking is tied to your survival, your brain goes into protection mode. You become desperate to avoid losses at any cost, and desperation breeds bad choices. Closing trades too early out of fear, holding losing trades too long hoping they recover, over-leveraging to make money back faster. Ironically, this fear increases the chance of losing exactly what you were trying to protect. The freedom of true risk capital. When you only trade with money you can afford to lose, the pressure vanishes. You can think clearly, follow your rules, and treat trading like a calculated business instead of a survival game. Calm trading is quality trading. How to calculate safe risk. 1. Determine your risk capital. This is the portion of your savings set aside for trading. Money that won't impact your daily life if lost. 2. Use the 1 to 2% rule. Risk only 1 to 2% of your account balance on a single trade. If your account is $10,000, that means risking $100–200 per trade. 3. Calculate position size. Use stop-loss placement to decide how many units to trade, so you never exceed your risk limit. 4. Build a safety buffer. Keep enough cash outside your trading account to cover at least 3 to 6 months of living expenses. The emotional advantage. Trading with risk capital removes the must-win pressure. When losses come, and they will, you accept them as part of the game instead of panicking. This mindset shift can turn an anxious trader into a confident, patient strategist. A quick reality check. If losing a trade would ruin your mood for days, you're probably risking too much. Healthy trading feels like this. Loss annoying but manageable. Win satisfying but not euphoric. That balance is what keeps your emotions steady. Action step. Your risk audit. Tonight, write down your total trading capital, your max risk per trade, in dollars and percentage. Whether your current trade sizes match those limits. Adjust immediately if they don't. Remember, your goal is to stay in the game long enough to win. The market rewards patience, discipline, and consistency, not quick thrills. Trading isn't about hitting one jackpot trade. It's about making hundreds of well-managed decisions over months and years. The best traders think like marathon runners, not sprinters. Why short-term thinking destroys traders? Many new traders enter the market chasing the big win. They want fast results, instant profits, and the thrill of overnight success. But this mindset often leads to overtrading to make it big quickly, taking oversized positions, ignoring risk management. One lucky trade might boost your account, but without discipline, one bad trade can erase it all. The compound effect in trading. Just like interest compounds in a savings account, good trading habits compound over time. Small, consistent wins build your equity and your confidence. Imagine making just 2% per week. That might not sound exciting, but over a year it's life-changing. Consistency beats perfection. You don't have to win every trade to be profitable. Even with a 50% win rate, you can succeed if your winners are larger than your losers. The key is sticking to your plan, not constantly changing strategies after a few losses. Avoiding emotional highs and lows. The long game means learning emotional balance. After wins, stay humble. One great trade doesn't mean you've mastered the market. After losses, stay calm. A single loss doesn't erase your skill. Professional traders treat each trade as just one step in a long journey. They measure success in months and years, not hours. Daily and weekly habits for the long game. 1. Daily journal review. Note your trades, emotions, and lessons. 2. Weekly strategy check. See if your rules are being followed. 3. C's monthly performance review. Track win rate, risk reward, and drawdowns. 4. Continuous learning. Read, study, and practice even on non-trading days. The power of patience. In the long game, there's no rush. Markets will be here tomorrow, next month, and next year. By protecting your capital, you give yourself endless opportunities to trade. The real goal isn't to win big today, it's to still be in the game tomorrow. Action step. Create your 5-year vision. Write down where you want to be in 5 years as a trader. Account size. Monthly income from trading. Lifestyle changes you want. Then break it down into yearly and monthly targets. This keeps your eyes on the horizon instead of chasing the next shiny setup. Final thought. A great trade can make you money. A great trading mindset can make you wealthy. Play the long game and let time, discipline, and consistency be your greatest allies. If you found these trading mindset secrets valuable, hit that like button to support the channel and drop a comment below with which rule you're going to apply. First, I read every single one, and don't forget to subscribe so you never miss the strategies. The pros don't want you to know. Let's grow smarter, more disciplined, and more profitable together.